Coming up on Market to Market. In the wake of oil train explosions in North Dakota and Canada, the federal government issues a warning for first responders. And off we go into the wild blue yonder as unmanned aerial vehicles raise hopes and perspectives for the next generation of farmers. Those stories and market analysis with Elaine Kub next.
This is the Friday, January 3 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Warren Buffett's company has agreed to trade about $1.4 billion worth of stock in Phillips 66 for one of the refiner's chemical businesses. Houston-based Phillips 66 said this week that Berkshire Hathaway will give up about 70% of its shares to acquire a business making additives that help crude oil flow through pipelines. The Oracle of Omaha has good reason to consider multiple methods of shipping fossil fuels. And that was demonstrated vividly this week when a pair of BNSF trains owned by Berkshire Hathaway collided in North Dakota. Residents of the southeastern North Dakota town of Castleton are back in their homes this weekend after a massive explosion following a crash involving two trains, one carrying grain and the other loaded with oil from the state's oil patch. The collision happened about a mile from the community, but the fireball and smoke trail could be seen for miles west of Fargo.
So we're coming in on 94, we're heading east, maybe doing 75, 80 miles an hour. And as we come underneath these clouds, it's almost like it was like nighttime, it was just dark. The entire sky is just blacked out, you can't see anything. And so we come in here, we're kind of digging around on these side streets, trying to get a close view. And it was a pretty surreal feeling overall.
A westbound Burlington Northern Santa Fe train carrying soybeans derailed first, and a portion of it fell onto an adjacent track carrying the eastbound BNSF oil train. 18 cars of the 106-car oil train left the tracks and burned. 2,400 residents of Castleton were under voluntary evacuation due to unsafe air. The order was lifted Tuesday after follow-up tests were completed. No one was injured in the incident. Investigators located a broken axle near the crash site, but have yet to say which train it belonged to. The signals around the crash site were in good working order, and the derailment point has been determined. Repair crews hope to have both tracks open late this week. The rate of oil train accidents remains low, but there has been a sharp increase in the past several years in the number resulting in spills. That increase is being driven largely by a surge in drilling in the Bakken Formation in North Dakota and other western states. North Dakota is the number 2 oil-producing state in the U.S., trailing only Texas. A growing amount of the oil is shipped by rail, and the state's top oil regulator expects as much as 90% of North Dakota's oil to be carried by train this year, up from 60% in 2013. The number of crude oil carloads hauled by U.S. railroads surged from 10,840 in 2009 to a projected 400,000 in 2013. Despite the more than 3,500% increase, the rate of accidents has remained low. Railroads say 99.997% of hazardous materials shipments reach destination safely. This week's mishap in North Dakota was not the only train derailment in 2013 involving crude. Back in July, 47 people died following a rail disaster in Quebec, and another train carrying crude derailed in Alabama in November. The Pipeline and Hazardous Materials Safety Administration issued a warning late this week for first responders that light, sweet crude being transported from the Bakken region may be more flammable than traditional heavy crude oil. Based upon preliminary inspections conducted after recent rail derailments in North Dakota, Alabama, and Quebec involving Bakken crude oil, PHMSA is reinforcing the requirements to properly test, characterize, classify, and, where appropriate, sufficiently degasify hazardous materials prior to and during transportation. The derailments were not the only incidents involving oil in 2013. 2 pipelines reported leaks in North America last year. One occurred in North Dakota and the other in Arkansas. The string of spills and derailments serve as talking points for both sides in the debate over the proposed Keystone XL pipeline that would transport oil from Canada and North Dakota to refineries in Texas.
I'd like to address the issues and concerns of pipeline safety that have permeated this issue.
In April, the former head of the PHMSA testified at a Keystone hearing in Nebraska. He told Market to Market then that leaks can occur, but insisted technology improvements would improve safety.
You know, with 13.5 billion barrels transported of crude and refined product transported each year, the safety rating is 99.9999952%, and that's pretty daggum good, and that's a much safer record than rail or truck or any other mode of transportation.
The Federal Aviation Administration is developing rules and regulations permitting commercial use of unmanned aerial vehicles or drones in American airspace by 2015. Drones are gaining in popularity, but the radio-controlled gadgets currently are prohibited from flying commercially. And safety and privacy concerns are complicating what was already an arduous task. In other countries, the value of remote-controlled aircraft was realized a long time ago. Japanese farmers have used helicopter-style drones to crop dust rice fields for decades. Today, unmanned aerial vehicles spray 40% of Japan's rice crop. But early adopters already envision widespread use of drones in American agriculture, and it seems the only thing higher than the innovators' hopes are the drones themselves. Josh Bittner explains.
Technological advancements have unleashed amazing inventions in recent years. It's doubtful any single device has made a bigger impact or been more widely embraced than smartphones. And with minimal modification, the components housed within many handheld devices are capable of controlling autonomous aircraft. While critics advise a more cautionary take-it-slow approach, proponents say the convergence of communication, aviation, and other scientific know-how is accelerating at breakneck pace.
I make the comment all the time, this technology is advancing really by the week.
With increased affordability and convenience, several industries, including law enforcement, disaster assessment, and even commercial delivery, are anticipating game-changing advantages via aerial drone technology. And while the term drones may conjure up controversial images of war machines performing strikes with surgical precision overseas, their domestic application also is subject to intense scrutiny.
When you fly this piece of equipment and you make a mistake or do something not responsible, there's going to be consequences.
Farming may be better suited than most industries to realize immediate beneficial results from an eye in the sky. While most crop scouting still is conducted on the ground, an elevated perspective offers a significant increase in agricultural data.
This is not a toy. It won't be long till it'll be rare for a farmer and agronomist not to have one of these at their disposal.
And as it's flying, I can easily just move it around.
Advanced cameras mounted on unmanned aerial vehicles, or UAVs, have been providing highly useful information to early adopters. Producers embracing precision agriculture, who already rely on GPS to guide tractors and apply chemicals, are rapidly adopting drones of various pedigrees. With the farming community abuzz about the cost savings these devices could yield, the future is looking up in rural America.
We're seeing students get picked up as instructors or trainers, and they're all kind of waiting for that commercial market to open here in the U.S.
Currently, profit-oriented drone flights are illegal, so widespread operation is grounded. But some research institutions have been granted limited waivers as they seek incorporation of UAV programs into their curriculums. The Federal Aviation Administration is engaged in the arduous task of drafting a comprehensive set of rules that would integrate these flying gadgets into the national airspace by 2015.
If we look up in the sky right now, we can see there's a private pilot out here.
In the interim, universities and hobbyists can fly, but not above 400 feet. And these discretionary flights generally take place over private property with a landowner's permission. Safety and privacy concerns are paramount to when the government formulates how to issue permits for commercial operation. Legislation primarily aimed at minimizing police overreach has been introduced in a number of states. And while organizations like the American Civil Liberties Union claim that the use of drones within U.S. airspace could lead to a surveillance state, some industry experts don't see an outlet for such data.
Is it possible to have 24-hour surveillance over somebody and invade their privacy? Yes, but it costs millions and billions of dollars, and there's not a market for that in the commercial world.
According to a March 2013 report, the Association for Unmanned Vehicle Systems International claims that drones will add over 100,000 jobs and $82 billion to the U.S. economy by 2025. With 6 federal drone test sites recently selected, Flyover Country offers the luxury of wide-open spaces to take UAV implementation to the next level.
The United States is not a leader in this technology right now, but we soon will be if the FAA removes some of the stumbling blocks.
Drones of various shapes and sizes were on display this fall as Kansas State University hosted a conference on unmanned aerial systems. Entrepreneurs and experts from across the nation descended on the Little Apple. Home of a proud tradition in aviation, K-State and its affiliate institutions provided an opportunity for investors and enthusiasts alike to discuss the range of challenges and opportunities for the emerging industry.
So it's a win-win scenario.
With abundant enthusiasm for agricultural use, some agronomists claim drones could also be a plus for the environment.
We can improve our ability to reduce the amount of runoff that go into our lakes from our agriculture, and we can improve the ability of getting nitrogen or nutrients in the places that's needed to increase the yield. So we'll increase the amount of production we produce on the same amount of land, even if we don't increase the amount of land we're planting on.
Savvy producers have already employed key pieces of new technology to their advantage. Town Line Farms is able to make timely, cost-saving water management decisions by probing soil moisture levels of its irrigated ground in central Illinois. Adding Normalized Difference Vegetation Index, or NDVI imagery, has provided an improved, nearly on-demand glimpse into plant health at any time of the growing season.
We were actually hiring an airplane to fly, and they would get us one shot, and it would be right before tasseling, which in this area is mid-July to early July. And we had one chance at it to get one shot a year.
The airplane that flew and took this image, without question, was I would say at least $100,000 airplane that cost several $100s an hour to fly.
With a background in farming and aviation, Chad Colby purchased his own quadcopter for less than $10,000 and collaborates with growers in his area. Colby is the Integrated Solutions Manager at Cross Implement in Minear, Illinois. The John Deere dealership's progressive clients eventually hope to use intelligence captured by UAVs to pinpoint underperforming areas on their farms.
I could fly the drone to that spot, take a photo of it, and from the headlands of the field, the grower could look at that data and then decide on an action. Do I have a hybrid problem? Do I have a weed issue? Do I have an insect infestation? Do I have a water problem? Hundreds of issues. And this is a huge tool for a grower. Huge, huge tool for a grower.
Spectral imaging lets you see the wavelengths that you don't normally see.
By shining a spotlight on specific challenges instead of casting a wide net, decisions from when to plant to cutting back on costly chemicals and additives can save farmers time and money.
We used to farm by the field. As we go forward, we've farmed by the acre. Now we're going to probably farm by 10 square meters. So that'll be kind of our size of our field. And we'll just have hundreds of thousands of little fields attached to one another. But as the equipment goes through, it'll adjust based on that microenvironment.
And as optical technology continues to march forward, the amount of data a farmer will be able to reap from a drone could increase exponentially.
Well, today, we're still putting the pieces of that puzzle together so they fit right. I think in the future, it'll be more of a seamline process. You'll buy a drone especially designed for ag. It'll come in a box. It'll be all ready to go. I think that's the stuff we'll see, and it's tremendously exciting.
For Market to Market, I'm Josh Bittner.
Next, the Market to Market Report.
Grain prices fell again this week as futures contracts were pressured by a surging dollar. For the holiday-shortened week, March wheat lost another 3 cents, while the nearby corn contract moved 4 cents lower. Despite favorable export numbers, soybeans also trended lower as the March contract settled with a loss of 43 cents. Nearby meal followed suit, giving up more than $20 per ton. In the softs, cotton's rally last week proved to be short-lived as the March contract declined by $1.18 per hundredweight. In the dairy market, January Class 3 milk broke through the $20 barrier with a gain of 57 cents, while the deferred contract moved 92 cents higher. Over in livestock, fat cattle traded in record territory again this week as the February contract settled with a weekly gain of $1.35. March feeders advanced by 30 cents, and the February lean hog contract improved by more than $1. In the financials, the euro lost 13 basis points against the greenback. Crude oil shed a whopping $6.36 per barrel. COMEX gold gained $25 per ounce, and the Goldman Sachs Commodity Index declined by 25 points to settle at 615 even. Here now to lend us her insight on these and other trends is one of our regular market analysts, Elaine Kub. Elaine, welcome back.
Thanks, Mike.
As we mentioned there in the lead-up, we saw a big sell-off this week in crude oil.
Yep.
Talk to us a little bit about what happened this week. What changed?
Well, the crude oil chart got really close to $100 per barrel, and I think traders just decided there is no justification for crude oil to be $100 per barrel right now. You know, the demand, the economy is recovering, but it's nowhere near exciting or growing at a great pace that would support $100 crude oil. So we've dropped quite a bit, come down to $94 per barrel. This was also coincident with the dollar going up and just sort of a general New Year change in the tone of trading. It seems like we've gone back to that risk-off idea. I think investors are jittery about the stock market being so high at the end of the year, but feeling like there's going to be a shoe dropping here at some point in 2014. And I think they had the feeling of getting off a lot of risk here in the first couple of days of the new year. Okay. All right. Now, you mentioned the dollar surging, and that kind of leads right into the exciting story on Friday that had people's attention was the wheat story. Saw an 8 to 10 cent rally across all three classes of wheat. Was that dollar related, or what's happened to the wheat market? I think what happens to the dollar from this point forward is very crucial to wheat's prospects. And I would point out that even though wheat came up on Friday a little bit, you're still looking at an unrelenting bearish trend in wheat. There was a new fresh contract low even Friday morning for the Minneapolis wheat contracts, and I believe also for Chicago wheat. It's just been 21 sessions in a row, I think, for the Minneapolis March contract to be having continual new contract lows. What happened in the wheat on Friday that brought it up is Egypt started buying. This is the thing that might change that trend, is eventually you'd think it's going to get cheap enough, somebody's going to want to buy this wheat. So Egypt put out a big tender, and between European wheat and American wheat, it's neck and neck for the price to get to Egypt. It works out to $300 a ton, is about $8, a little over $8 per bushel in Egypt's front door. So what happens to the euro and the dollar right now is going to determine which of these wheat markets is going to be able to go to these foreign customers. All right, and either way, we're finding a buyer for the huge global wheat supplies that we've got out there. Well, we hope. I mean, hopefully somebody's going to step in here and buy that. And Canada, obviously, is going to be trying to compete for this business also. They have so much wheat right now. The elevators, aren't even willing to accept more wheat from the farmers who are desperate to deliver it. They have just crushed with wheat there. And advice to producers in that situation. I mean, how do you handle trading in this wheat market that we've got? What does the future look like? Well, I mean, the conventional wisdom would say to store it. I mean, hopefully you've got the storage to store it. And the good news is that there is a carry spread in the wheat market, so the market will reimburse you for those costs of storing it, of keeping it off the market. Well, they just can't handle it right now. Any price points or ranges out there you think producers ought to be keeping an eye out on while they've got it in their bin? It's really hard to say. Like I said, we haven't been able to establish any sort of a pattern that would change that trend. It remains to be seen if this upward movement on Friday would change. And I think I would look ahead to the January crop report, obviously, as the next big thing on the calendar that could spark some sort of excitement. I don't know that there's anything in there that's going to be bullish for wheat, probably increase Australia's numbers, which is actually bearish. But that's something that could change a trend. Wait and see what happens if what happened on Friday is a major trend reversal, or if it's just a blip in the unrelenting bearishness. Probably. All right. Well, let's take a look at corn. Where are we at in the corn market? How do things look for the old crop 13 corn? It was interesting. Again, there was a new contract low for old crop corn. The March contract had been holding steady at $4.18 and a half, and now on Friday it slipped down below that $4.17, so there does not seem to be much support there. You're looking at $4.10. If it goes below there, it probably starts hitting some stops, and with that January report coming up, historically that is a day of incredible volatility for the grain markets. It always tends to be very wild on that day, possibly in both directions and maybe changing the trend, maybe not. But if you hit those stops, like I said, we could end up with, lots of downward movement in the corn market.
Now, and we are expecting that report's coming out next Friday, I believe. How should producers prepare in advance of that report because of the volatility?
Right. For both old crop and new crop, honestly, I think that the best opportunities are going to be ahead of us in the spring. We're going to go back to this pattern that it used to be when we had abundant crops, where you would have a seasonal high in the spring when the crop is having the most risk. So if you're looking at maybe making your sales in the March, April, May, June sort of time frame, that's a plan that I think makes sense in this kind of a year. But the risk of it is that in the meantime, if you don't have anything sold and you're intending to sell in the next few months and need some cash, yes, you should probably be doing something right now like buying puts or putting some sort of downward protection on your crop.
Because if your plan is to wait until March, April, May, and you see corn with a 3 in front of it,
yeah,
it's going to be an unpleasant springtime for a lot of producers out there sitting on bins full of corn. Now let's take a jump down to soybeans. We're talking bearish news throughout the grain and into the oilseeds market. 43 cents almost this week in old crop soybean prices. What happened?
Well, what happened, there was a time there, when the bullish story of the United States, where our tight supply and demand was really driving that old crop market. But looming over this for months now has been the idea that the Brazilian and Argentinian crops are going to be huge. And that is continuing to be the case, and even more so. I think that's what really triggered it this week. There has always been this idea that it had been a little bit dry, but the forecast turned very decidedly wet right as it's filling the pods. We're fairly safe to say that they're going to get the 88 million metric tons in Brazil, possibly up to 90 million metric tons is an idea that has been tossed around. So that could be some very bearish news coming in, again, on that January 10th report. So somewhere between now and next November, there's a $1.57 spread between the old crop and new crop soybean futures, and those are going to have to come together somewhere. And my feeling is that it's probably going to be closer to the downside, to the new crop prices.
Now, how much risk is there on November 14 beans? Would this be a time for producers to be making sales, looking at a potential 90 million metric ton crop?
Right. That also took a great hit this past week. And I think that if you could see that November contract get back above $12, that's a great selling opportunity. It's not there now. And again, with all this bearishness coming out of South America, it may be like corn, not something that we're looking at in the very near term, but again, more of a seasonal pattern, hoping to see some sort of battle for acres develop in the spring.
Maybe late spring into the early part of planting season, maybe get a weather scare and see what happens.
Right.
All right. Well, now let's take a jump down to livestock, break the bearish trend. Now we've got bullish stories going on in the livestock market. As we talk fat cattle, we had record high cash prices paid in Colorado at $139.
$139 is the story I heard.
What's happening in the cash cattle market? Where is all this demand coming from?
Well, the packers are finally, just having to pay these prices. And it's not necessarily because they're making money. They're probably not making money or not making very much money buying fat cattle at these prices, but they just are not able to find the supply out there. And this is just the price that they are simply having to pay. So that seems to be what's causing that. And the futures is following that also. That also hit a new record high of all time here on Friday.
How high can this go realistically as we look at demand factors in America and overseas? Is there still some life left in this rally?
Yeah, well, 139 is awfully close to the psychologically significant 140 number, which would be historic to see, obviously. And you think back the last 5 or 6 years where you get commodities that go on these wild tears and sudden streaks. I don't have the feeling that the fat cattle market is going to be like that, simply because there's not enough room for those packers, like I said, that are not making money. You're not seeing the box beef market at any new record high. It's at $200, but it's not at a record high. So I don't see this going on a tear, some speculative upward streak. I see this being maybe getting to that 140 level, but tapering off.
Kind of creeping up there and then possibly holding steady dependent on where demand runs.
Right.
Now, I know we've had some talks in Korea. Jamie was on last week, talked about how Korea might be opening up their cattle under 30 months of age. Have we heard any more on that in this past week? Is that looks like it's going to happen? Or
I don't know, and I don't know that that's been what's driving the factor. There was another little bullish snippet of news this week that the USDA is allowing or recommending the school lunch programs to include more lean protein or larger portions of them. And I know that's something that has been challenging the beef market in particular, to not have that ability to move into that market. So there was one little piece of bullish demand news for you.
All right. Well, now let's take a look at feeder cattle as we watch corn touching new lows. Feed prices have come down substantially. Does that give the feeder cattle market time to move or room to move with record high cash fats and lower corn?
It was It was interesting to me to note that they did not. You know, they stayed steady this week. They certainly did not drop, but they did not establish new contract highs in the way that the fat cattle market did. And that may be a representation of not being certain about that corn market perhaps coming back up, not being very optimistic about the fat cattle, like I said, getting much above 140. For whatever the reason, it doesn't seem like that cash cattle, the feeder cattle index is probably going to get any higher than 166 for the time being.
Okay. Well, now let's jump to hogs for a minute. Hogs, we were on a bit of a sell-off last week, turned it around, saw a dollar move north. What happened last week to change that sentiment in the hog market?
And certainly in this week, too, there were a couple of exciting upward days in the hog trade just this past couple of days as the new year got started. And there are some bullish stories here about the supply of hogs being down, probably based on the virus activity that happened late last year. And also there was some bullish concern about the transportation, the logistics of actually getting the supplies where they needed to go. But really these were bullish stories that, like I said, inspired some excitement in the futures trade. But I think that it's overdone, and in the actual cash trade, you know, is probably still pretty close to that $80 level, and the widening discount between the futures and the cash business and the hogs.
Now, as we look to this next week, we're seeing record cold temperatures across much of the country, the flash blizzard that struck the Northeast. How do the cash prices for livestock look here in the short term?
You know, I don't think that that's going to have a lasting impact, or it's something that you sort of see every winter, so these things will happen. But as far as actual demand, or the actual supply and demand, the supply of hogs, the numbers may be slightly down, but their weights are higher. So you're really not looking at a fundamentally bullish story to the hog market. I would be more neutral for the next few months in hogs.
All right, at 420 corn, should we be looking to cover some feed needs, do you think?
I think absolutely. I think that there's, you know, whatever bearishness is known about corn is fairly well known. So except for the volatility that may be downward, this would be a good opportunity.
All right. Thank you so much, Elaine, for being with us tonight.
Thanks, Mike.
That wraps up this edition of Market to Market. But Elaine and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. And be sure to join us next week when we'll examine the impact of USDA's annual production summary. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.